Buying a house in Malaysia can be a significant investment, and it's important to understand the process to ensure a smooth transaction. Here are some key things to consider when buying a house in Malaysia. Budget. Before beginning the house hunting process, determine your budget. Take into account all expenses, including down payment, monthly mortgage payments, property taxes, insurance, and maintenance fees. Location. Decide on the location you want to buy a house in. Consider factors such as accessibility, proximity to schools, hospitals, markets, and other essential amenities. Type of property. Choose the type of property you want to buy. Options include apartments, terrace houses, semi-detached houses, bungalows, and condominiums. Each type has its pros and cons, and you should consider factors such as space, privacy, and maintenance requirements. Research. Research the property market in the area you're interested in. Look at property prices, amenities, and any future development plans. You can do this online or consult with a real estate agent. Real estate agent. Engage the services of a reputable real estate agent who knows the local property market. A good agent can guide you through the process and help you find the right property. Loan. Apply for a housing loan from a bank or financial institution. Make sure you understand the terms and conditions, interest rates, and monthly repayments. Legal documents. Once you have found a property, engage a lawyer to handle the legal documents. The lawyer will handle the transfer of ownership and ensure all legal requirements are met. Inspection. Before finalizing the purchase, inspect the property thoroughly to ensure there are no defects or issues that need to be addressed. Negotiation. Negotiate the purchase price with the seller. Your real estate agent or lawyer can help you with this process. Stamp duty and other fees. Be prepared to pay stamp duty and other fees when purchasing a house in Malaysia. The fees vary depending on the property price and location. The legal fees and taxes associated with buying a house in Malaysia can vary based on various factors, including the property value, location, and type of property. Here are some estimated costs for legal fees and taxes. Legal fees. The legal fees for buying a house in Malaysia are regulated by the Solicitor's Remuneration Order, SRO, 2005. The fees are based on the property's value and can range from 0.4% to 1% of the property value. For example, if the property value is Rm 500,000, the legal fees could be between Rm 2,000 to Rm 5,000. Stamp duty. Stamp duty is a tax imposed by the Malaysian government on legal documents, including property sale and purchase agreements, loan agreements, and transfer documents. The rate of stamp duty varies based on the property value and the type of document. For example, for a property sale and purchase agreement worth Rm 500,000, the stamp duty is 1% of the purchase price, which would amount to Rm 5,000. Real Property Gains Tax, RPGT. RPGT is a tax imposed on the profit made from the sale of a property in Malaysia. The tax rate is 30% for properties sold within the first 3 years of ownership and reduces to 20% for properties sold between 3 and 5 years of ownership. There is no RPGT for properties sold after 5 years of ownership. Goods and Services Tax. GST. GST is a tax on goods and services in Malaysia. It was abolished on June 1, 2018, and hence, it is no longer applicable. Before giving a loan to buy a house, banks typically conduct a thorough assessment of the borrower's financial situation and the property being purchased. Here are some of the key factors that banks typically check. Credit history. Banks will review the borrower's credit history to assess their creditworthiness. They will look at factors such as payment history, outstanding debt, and credit score. Income and employment history. Banks will review the borrower's income and employment history to ensure they have a stable source of income and can afford to repay the loan. They may request documents such as pay stubs, tax returns, and employment letters. Down payment. Banks will typically require a down payment of at least 10% of the purchase price of the property. The borrower's ability to make a down payment can impact the loan amount and interest rate. Property valuation. Banks will conduct a property valuation to ensure that the property's value is in line with the purchase price. They may also review the property's condition, location, and potential risks. Debt-to-income ratio. Banks will review the borrower's debt-to-income ratio to assess their ability to repay the loan. This is calculated by dividing the borrower's monthly debt payments by their gross monthly income. Legal and regulatory compliance. Banks will ensure that the purchase and sale agreement, title deeds, and other legal documents are in order and comply with all applicable laws and regulations. Based on the results of these assessments, banks will determine whether to approve the loan and the loan amount, interest rate, and repayment terms. As a general rule of thumb, financial experts recommend that your monthly mortgage payment should not exceed 28% to 36% of your gross monthly income. This means that the price of the house you can afford to buy will depend on your salary or income. For example, suppose your gross monthly income is room 6,000. In that case, your monthly mortgage payment should ideally be between room 1, 680, 28% of room 6,000 to room 2, 160, 36% of room 6,000. Assuming a mortgage interest rate of 4%, a 20-year loan term, and a down payment of 10%. The following table shows the estimated price range of a house you can afford based on your monthly mortgage payment. Monthly mortgage payment estimated house price range. Room 1, 680. Room 332, 500. Room 415, 625. Room 2, 160. Room 427, 500. Room 534, 375. It is essential to note that this is a general guideline, and your individual financial situation and goals may vary. You should consult with a financial advisor or mortgage specialist to determine the most appropriate price range for you based on your income and financial goals. The profit you can expect from buying a house and selling it after 5 or 10 years will depend on various factors, including the location of the property, the current state of the property market, the overall economic conditions, and the original purchase price of the property. As a general rule of thumb, real estate experts suggest that property values tend to increase by an average of 3 to 5% per year. If you bought a property for room 500,000 and sold it after 5 years, assuming an average annual appreciation rate of 4%,